Well, good morning. Senator Hall and Delegate Nelson, thank you for the invitation to appear before you today, and thank you, ladies and gentlemen of the committee. I suppose I should preface all of this by saying that our mission at the Tax Foundation is one of a national scope, and that we are not West Virginia experts. We've done our best. We've read the Underwood and Manchin reports. We've read through Russ Sobel's book, read through the tax expenditure reports, and of course we deal with state tax policy all over the country. And my colleague Jared has answered the call of the Wild and Wonderful ads and has come out here a number of times for some hiking and rafting on the rapids and so forth. But I do want to note that you had a wonderful panel this morning with a lot of great insights, and I agree with all of them. Even where they disagreed with each other, I agree with all of them. And indeed, you've got some great organizations here on the ground that I respect greatly, including the West Virginia Center on Budget and Policy and the Cardinal Institute, to help you go through a lot of the issues that you're now facing. As I said, our mission is a much larger one of providing a national perspective on a lot of these issues and analyzing where things are in terms of trends. And so that's what we're going to try to provide you with today. Now, I said I did agree with everything that's said on the panel. I do have two exceptions I wanted to point out just kind of right off the top, and I think they relate to some of the questions that Senator Hall was leading towards. One exception I would have would be the framing of the competitive environment as one of a regional one as opposed to a national one or a global one. Regional competitiveness certainly matters, but in a day where technology allows communication and travel to be about as instantaneous as it's ever been, and where people can work just about anywhere they want to work and businesses can locate just about anywhere they want to locate, you need to look at things in a national or even, as Dr. Sardarelli was going into, a global context. Today we'll talk about, in this presentation, a national context, but I would be very careful about just trying to beat Ohio and Pennsylvania and Kentucky. I would think much broader than that, because businesses are thinking much broader than that, and individuals are thinking much broader than that. I mean, you all have children and grandchildren, and what are they thinking about in terms of where they want to go to college and where they want to live? And you all have businesses among your constituents, and what are they thinking in terms of getting investment and growing their jobs base? And the businesses that are coming into West Virginia, and more importantly, the ones that are not, what are they saying about that? What is deterring them, and what is inviting them? The other exception I would make, and we'll go into more detail on this, is the characterization of West Virginia's tax system is pretty good. I don't think it's pretty good. I think it's middle of the pack. It's not terrible. It was terrible, but now it's middle of the pack. And maybe this is just a matter of semantics, but you know, there are states in this country that have pretty good taxes in terms of for individuals and businesses. I mean, like a state like South Dakota pretty much has a broad-based sales tax, and that's all they really have. They've got a pretty good tax system, and that enables them to overcome a number of weaknesses that they face. Somebody asked a question in the last round of kind of what's the ideal tax system. There are people out there who peddle ideal tax systems, one size fits all for everybody. We're not one of those organizations. For us, a tax system has to reflect the strengths and weaknesses of a state. So what are the strengths and weaknesses of West Virginia? And to the extent that taxes can play a role in overcoming some of those weaknesses, that's the line of reasoning. If you took New York's tax system, which is very complex and burdensome and high, and you put it in South Dakota, you would see a much more negative effect on South Dakota than you see in New York, because New York has countervailing strengths. They have 3 international airports, they have Wall Street, they have Broadway, they have the ability to get a hot sandwich at 3 in the morning, these things matter to different people. that's an important consideration to keep in mind, is what are the strengths and weaknesses that West Virginia faces, and then what role does taxes play in either accentuating the positive or overcoming the negative. We work at the Tax Foundation, so we're going to talk a lot about taxes, but I'm always the first to concede that taxes are not the only thing that affect individual and business location decisions. And I read all the research, lots of things matter. Taxes certainly do play a role, and wherever you stand on the political spectrum, that's conceded. But other things play a role. Education matters, transportation matters, regulatory policy matters. I even read one study that said where the wife of the CEO wants to live has a measurable effect on where the corporate headquarters is located. So lots of things matter, and weather matters. And so another way of framing the problem is, what are the characteristics of West Virginia, and what models are there out there to follow? So I started thinking of, what are other mountainous, landlocked, kind of out-of-the-way states? And three came to mind with actually very different characteristics, and that's Tennessee, which I think was mentioned on the panel earlier, Colorado, and Vermont. And they're all very different. Tennessee has no income tax. They have a very high sales tax. Colorado has, let me do Colorado last. Vermont has very high taxes, very high income tax, very high business taxes, very high property taxes. And then Colorado's kind of in the middle. They have all of the major taxes, but they've made a concerted effort to make them all broad-based and low rate, as flat and as generally applicable as possible. There's also other interesting characteristics. Obviously, the Tennessee of 50 years ago is very different from the Tennessee of today in terms of the public perception, and that matters a lot. People today, when you think of Tennessee, you think of music generally, and that certainly was not the case a while ago. Vermont, I don't know, you think of ice cream or something like that, but they've made an effort to make a brand for themselves. In Colorado, they've got Denver, they've got Aspen. Nowadays they have marijuana. I get a lot of questions on marijuana in Colorado. But they've made an effort to brand themselves to play up their strengths, and that certainly is an important thing too. So with that, so kind of how we're going to go through this is we put out a lot of reports and rankings and presentations every year, and my colleague Jared's going to walk through a lot of that information and answer your questions on where West Virginia stands in a national context. Just in going through those, there's some observations that we developed, and Jared will walk through those, and then after that, we'll kick it back to me, and I'll kind of walk through 10 things that states have done recently that are notable, just so you're aware of the competitive context in terms of tax reform that's happening in other states. And then we'll definitely be available for questions. We're here the rest of the day. We'll be here through the other presentations as well as afterwards if anybody has any questions. And then before I turn it over to Jared, just one final note. West Virginia's high schools graduate, I looked it up, about 17,000 graduates a year. And I think there was a bit of a debate on the last panel of the efficacy of targeted incentives. And again, I agree with both of the perspectives that were laid out. So I just want to add one further comment that no one had mentioned, which is if you've got the most effective economic development program in the world that's creating, a ribbon cutting every week of 100 new jobs, luring in some new business and everybody gets to cheer when it opens, net, 100 new jobs, net of those that are closing. And I'm a lawyer, not an economist, so I had to get out my pen and paper on this one. But 100 new jobs every week is about 5,200 jobs a year. And that's not even a third of what West Virginia high schools are putting out every year. So you need to look broader than just deals for individual companies. You need to have an economic system that is naturally creating this stuff, and a tax system that encourages it, and a regulatory system that encourages it, and an education system that encourages it, and a transportation system that encourages it. And later on we'll go through states that have been doing tax changes, but very rarely is the tax change done in isolation compared to other policies that are done. So North Carolina we'll talk about, for instance, and what I won't mention in the slide, but I'll mention now, is that North Carolina didn't just do tax reform 2 years ago. They also did unemployment insurance reform because that was a big challenge they faced. They also did transportation funding reform because that was a big challenge that they faced. And so too with some of the other states you'll see. New York will talk about their corporate reform, but of course the governor's done a lot of other significant changes to advance their state. And so too here, and you've heard about some of the other non-tax challenges that West Virginia faces earlier, and I would keep these in mind, even though this is a tax reform committee, because you can't think about these things in isolation. With that, I'm going to turn it over to Jared to walk through some of the analysis. We've got some slides here about who we are. We're founded in 1937. We've got principles. You can read in the packet. Let's get to the good stuff. Yeah. Is that better?
All right, I do want to briefly mention the principles that we abide by, and we value a tax system that is simple, neutral, transparent, stable, and pro-growth, and that informs all of our analysis. What I'm going to go through right now is several of the studies that we do, different rankings, different ways of looking at tax systems, because there isn't just one way to look at this, and it's important to look at different contexts. The first, and I will be putting a few items on the screen in the back, is something we call our State and Local Tax Burdens Index. And this goes beyond just the sort of census collection of total taxes paid divided by state product. That would be the simple way of doing this, and we look at that. But burdens is intended to look at the total tax burden that all West Virginians experience. In-state taxes, out-of-state taxes, taxes that are paid on a prorated basis. It is every tax at every level that West Virginians themselves pay, wherever they pay it, obviously modeled. And West Virginians pay about 9.7% of their income in state and local taxes. That ranks, it's 19th highest in the nation. And you can look, if you wish, there is that burden over time overlaid with the average U.S. burden. You can see that West Virginia has been typically below the U.S. average since the mid-1980s. There was a period where it did spike. There was obviously a lot of change in the tax system in the 1980s, which some of you are probably very familiar with, including at the time extremely high individual personal income taxes, and a lot of efforts to move revenue around for a few years. But for the last several decades, it's typically been a little below the national average. We put together, this is one of our bigger publications, is the State Business Tax Climate Index, and we look at a number of different factors. We look at the effect on corporate, individual income taxes, sales tax, unemployment insurance taxes, property taxes, basically looking at the breakdown, how competitive is a state on each of those rankings. West Virginia is very much middle of the pack. Overall, West Virginia ranks 21st on, and you can see the rankings if you wish in your packets or in the back. But on corporate income taxes, it ranks 17th. This is an improvement because West Virginia's corporate income tax is now 6.5%, which is a reduction. I believe it was at 9% previously. The individual income tax, very middle of the pack, 26. It's a graduated rate. It's regionally fairly high, fairly middle of the pack nationwide. And you have seen a number of changes in that base and the number of brackets over time, but you have, I believe, 6 brackets now. Sales tax, also middle of the pack because of its rate, but a fairly well-structured tax base, meaning that it is broader than most states. It does cover some degree of services because the way the base is structured, it begins with everything and then it carves out exemptions. And it carves out exemptions for a lot of services, but it doesn't do so to the degree that states which simply start with the assumption that it's only on tangible personal property and don't include any services would. So a somewhat broader, somewhat more equitable base it does perform fairly well compared to other states. Unemployment insurance, again, middle of the pack. Property also maybe perhaps somewhat surprising, middle of the pack, despite low rates. Certainly West Virginia does have low property tax rates, but that base is very broad. It includes inventory and equipment. Really, it includes practically all personal property, tangible personal property. There are some exemptions both on types, so nonprofits, churches, governments don't pay some of those taxes. Also, there are exemptions and carve-outs for different types of property and different rates. You have different rates on different classes of property, and a 50% on on owner-occupied housing compared to everything else, all other, compared to other real property, and then tangible property being taxed based on the 4 classes. I'll go into those a little more in a minute, but want to jump ahead to another study we're doing, and this is a bit of a preview. We do a study called Location Matters, and the data I have here is actually in a forthcoming edition that we'll be putting out in hopefully sometime early summer. But this is our 2nd edition. Location Matters is very much geared towards the question of what are the effective tax rates that actual businesses experience. Because every business is structured so differently that you can look at what is your tax structure and still not have a good sense if you are, if you're in the legislature and you're trying to figure out how do we bring in these larger firms, or if you are a business professional thinking, where do I want to go? This is an effort. We take 7 model firms. And of course, you have to make assumptions of model firms. These do not perfectly model what any individual firm would experience. But we take a sort of typical corporate headquarters, R&D facility, retail store, larger one, a call center, distribution center, and then both capital and labor-intensive manufacturing facilities. Sort of the 7 types of businesses that most economic development agencies are thinking of targeting. Retail may be less, but generally speaking, these are what economic development agencies are looking at bringing into the state. And you can see that, unfortunately, West Virginia ranks fairly poorly on most of these. And there are a number of reasons for that. So drivers of these rankings include, obviously rates are important, and we'll talk about rates, but I wanted to talk about some things that maybe are less intuitive. One is a throw-out rule. West Virginia is one of only 2 states that has a throw-out rule. A number of other states have a throw-back rule, but this deals with the question of what do you do with income in a West Virginia-based business that is not directly taxable in another state, but may be generated out of state. Some states throw that income back to the state and bring it in part of the sales base. West Virginia uses a throw-out rule where they don't include it in the apportionment formula, which again means higher taxes that are being paid in state based on income that's produced out of state. It can look good for revenue purposes, but it can be uncompetitive for businesses, especially if they end up having operations, or if they are selling across the nation, it's potentially highly uncompetitive for them. So that's one issue. Also with apportionment, you have double-weighted sales factor apportionment. It's a difficult question to say what is the ideal apportionment formula, and I don't know if Joe might want to go into this more, but it is arguably an uncompetitive apportionment formula for many of the firms that we looked at least. Some states do equally weighted, evenly weighted, 3-factor apportionment. Some do single sales factor apportionment. Double weighted is probably a little less common and is, at least I could say, less of a competitive advantage for the firms that we studied, although there would be some that might benefit from that. Similarly, sourcing rules. Income in West Virginia is sourced at the basis of income producing activity. So a firm that provides services, that sells out of state. So let's say you're bringing in a tech firm and maybe they sell software, and they're selling their software out of state, or maybe they're selling software services out of state. If they don't have nexus in other state, it's a question of where does that income get sourced. West Virginia's sourcing rules are going to be less competitive for them than for many other states. And then finally, one thing that was very significant for some of these firms is that the property tax does extend to inventory and equipment. You have a decent number of states where it applies to equipment, fewer where it applies to inventory, still fewer where it applies to both. And that does put West Virginia at a significant competitive disadvantage, and especially as we talked with people about where West Virginia wants to go. And I'm sure that different people have different perspectives of where West Virginia should be headed, but I think there's a broad recognition that there has to be a broadening of the economy, that you have to have a more diverse economy in the years ahead. I know manufacturing has been historically a significant part of the base. I know that there is a hope that it can grow again, and yeah, we'll go into this. But if you want manufacturing to be a significant portion of the economy, property taxes on inventory and equipment are not necessarily conducive to that.
Apologies,
This is hard to see.
Not only is it hard to see, it's also not in your packet. I was staring at it most of yesterday and liked it so much I wanted to put it in the slideshow, but it was after we printed them. So we'll walk through what you're looking at here. It's a lot of gobbledygook.
So this is the economic sectors that comprise West Virginia. And as you can see, mining is the single largest sector at 18%. Government is actually second at 15%, and that's state, local, and to some degree, federal government. And after that, everything gets down to, I think everything else is manufacturing 10%, and then others at 9% or lower. Real estate, retail, healthcare are all around in that area. This is, probably more of a concentration in a relatively small number of industries than one would typically see in most states. And also, you would see that services, finance, retail are lower than many states would have. Also maybe accommodation and food services, although that's not as far up, as West Virginia does have a relatively thriving tourism sector. But nonetheless, this poses a challenge for West Virginia, and a lot of states are experiencing this challenge. States that have historically had one particular type of economy, and West Virginia has been a resource extraction economy and to a significant extent a manufacturing economy. And while both of those things will continue for some time to be very significant drivers of West Virginia's economy, I think there's a recognition they can't be everything. They probably can't be as large of a part of the pie as they are now in 20, 30 years. So there is a need for a tax structure that allows that diversification. And you heard earlier some back and forth on the question of incentives. And incentives tend to target one industry over another. And if you want to grow and expand your economy and allow that diversification that can allow continued growth, a tax system that is fair across the board, that is competitive across the board, is probably the best way to avoid overloading one sector as you try to grow your economy. West Virginia has done a number of very good things in tax policy in recent years, and part of this is you've had a number of similar commissions, similar structures to this. In 2006, Governor Manchin pushed forward with a tax reform commission. In 1999, Governor Underwood did. I believe there was one in 1983 or perhaps 1985. I apologize if I'm getting the year wrong. But there have been a series of these, and positive reforms have come out of them, particularly with regard to the last one. There was a reduction in the corporate income tax to 6.5%, a phase out of the franchise tax, which has been, I think, can be very helpful going forward, and a rollback of tax incentives. West Virginia still has a decent number of tax incentives, but I think they're probably a smaller share than in many states. And that's a good thing because it's going to help the state broaden its economic base. There are a lot of further opportunities, some things that stood out to us as we were looking at West Virginia's tax system. And some of these are more difficult than others, we recognize. Firstly, looking at phasing out the local business and occupation tax and recognizing and conceding immediately that this is a significant source of local revenue. In many municipalities, but many of the larger municipalities, it may even be a majority source of revenue. And we did go through the tax expenditure reports, the full 3-year cycle of those. We've obviously gone through the tax studies, and we've looked at what this revenue means, and obviously this is a local form of revenue, so we've looked at some of the municipal budgets as well. But this has been something that both of these two previous reports have recommended finding a way to address. Obviously, in 1987, the state eliminated the B&O tax on most industries. It's still on public utilities and a handful of other select businesses. I believe there are a total of about 120 payers of this tax at the state level at this point. But there are many payers at the local and municipal level because this is still a significant business tax at the local level. Previous commissions have looked at options for replacing some of that revenue, everything from locals piggybacking on state taxes to allowing greater authority for different tax assessments. I would simply say that I would hope that this would be something that this commission would seriously consider would be a way to address that B&O, because it is an uncompetitive tax. It is levied without regard to ability to pay. It's on gross receipts, and therefore it is inequitable with regard to businesses, because businesses experience dramatically different margins. You have some businesses that experience margins of 1 or 2%, others that might experience margins of 10, 15, even higher percent. If you're taxing both of those types of businesses on gross receipts, you are not achieving equity. There was talk earlier about horizontal equity, that similarly situated businesses, similarly situated taxpayers should be paying similar amounts. You do not get that with a gross receipts tax, which also tends to do tax pyramiding. It's just an economically inefficient tax. And I think that's been recognized in all of the previous commissions. It's obviously difficult to address something that is a significant source of local revenue, but finding ways to replace the needed revenue and get rid of a tax that is, I think holding West Virginia's job creation market back would be important. We looked at collapsing and reducing individual income tax rates and brackets. You can see here a map, well, you can sort of see.
Everything has that on.
Yeah, and part of it is because I was too lazy to put in all the numbers, but we do on our website. Obviously, we have all of the numbers for you to see all of the highest rates. But you can see that West Virginia does have the highest of the region's individual income tax top rates. It's a graduated tax. Several of the surrounding states do not have graduated taxes. And those that do, it's still a lower top marginal rate. So there is some lack of competitiveness there. I know that previous commissions had looked at the possibility of collapsing those rates. I believe the Manchin Commission proposed 2 rates. The Underwood Commission proposed 1, but with a large personal exemption that was to be tied to, I believe, the poverty rate. There would be a number of different ways to address this, but collapsing those brackets and reducing rates obviously would be conducive to growth. We also looked, West Virginia is one of the states that does not index its brackets for inflation. You see here is a map of states. Some states, of course, don't have an individual income tax. Of those that do, I believe that West Virginia is one of 18 that does not index for inflation. You can see that several of the surrounding states also fail to do so, but this is an opportunity to potentially get ahead of some of those states, to do something that others aren't, that hopefully as the economy grows, as individual income grows, as just as inflation kicks in, are those brackets going to be adjusted, or is the tax essentially going to become more burdensome over time? Another one, a big one, is personal property, and all personal property, because personal property is included in the property tax base with limited exceptions in West Virginia. Property taxes are 28% of all business taxes. I think people often, when they hear business taxes, they think corporate income tax. Well, according to Council on State Taxation, who will be testifying later today, in West Virginia, only 6% of the taxes paid by businesses go to the corporate income tax. Others go to property taxes, sales tax, excise taxes, special taxes, there are UI taxes, a lot of different pieces of the pie. But property taxes are a very significant portion of this burden. Now, some of that's real property, and real property meets the benefits test. Real property taxes tend to be less of a disincentive to economic activity. Those make sense. However, as you can see here, of Class 3 and 4 property tax collections, which is basically what businesses are going to be paying, non-agricultural businesses, 43% of those collections are personal property. Another 17% is public utility property, and then the remaining 40% is real estate. And that's highly significant. Again, I mentioned earlier that you have some states where equipment is in the base, some states where inventory is in the base. In West Virginia, pretty much everything is in the base.
This is a literal tax on business equipment.
So, this is, obviously a disincentive to economic activity. It's even a disincentive to replacing, depreciated equipment, on the same schedule that businesses might otherwise, because it goes back into the tax base at a higher rate. So it's discouraging business expansion and growth. It's obviously discouraging businesses from coming here. I think that's definitely an opportunity if that can be addressed. And that's also been something that previous commissions have looked at and has been discussed previously. And again, significant source of revenue. I know that both of these larger items are local, they're municipal taxes. So there would have to be efforts to figure out replacement mechanisms, and there have been proposals, whether it's piggybacking, whether it's additional authority, whether it's providing other tax options, getting away from these taxes that are particularly disadvantageous for economic growth and development would be extremely helpful for West Virginia. And finally, in the list of recommendations, things that we saw as we were looking at the West Virginia tax climate is, as I mentioned, that the throw-out rule. West Virginia is one of only 2 states with a throw-out rule. There are a decent number of other states that have a throw-back rule, but in both cases, you are taxing more income than is generally attributable to the state itself, which is going to discourage businesses, especially those that are shipping out of state or providing services out of state. So if you want to bring manufacturing here, manufacturing facilities are selling substantially out of state, and they are going to be particularly burdened by a throw-out rule. We talked about the service sourcing. If you wanted to grow a tech sector in West Virginia, that is potentially going to harm them. There are obviously other issues that previous commissions have looked at, one of which we didn't include in here but was referenced by the previous panel is, of course, the breadth of the sales tax base. I know that's been looked at. There are certainly many opportunities for reform. What we've included is not meant to be an exhaustive list, but hopefully a few options for further action. We would be glad to discuss these with you in questions, in follow-up in future days, weeks, and months. And after that, I'm now going to turn it back over to Joe to look at some examples from other states.
And actually, before you leave the slide, I recognize that you guys are busy people and you may not know throwback, throwout, and kind of what those things are. But you're in luck because you did invite Ferdinand from Cost, who is an expert on this, who will be testifying next. But just to preview it a little bit, this is corporate tax apportionment. So, you've got multi-state corporations that are operating in many states. How do you determine what share of their profits are taxable in West Virginia versus in other states? And generally, in the 1950s, states adopted a rule where it's an average of 3 different factors: an average of the sales in a state versus nationally, plus the share of property in the state compared to nationally, plus the share of employees in the state compared to nationally. And you average those, and let's say in a case of a company that equaled 7% was in West Virginia versus 93% in other states, then West Virginia would get to tax 7% of that corporation's profits under its corporate income tax. This has changed over time. More states have moved to double weight the sales factor. You may have heard that term, or move exclusively to a sales factor, also known as single sales factor, and that's been some of the trends out there. Throwback and throwout rules try to mitigate the effects of those changes by extending the state's taxes to income earned in other states but not taxed in other states. So for instance, say you had a company that operated exclusively in Nevada and West Virginia. Nevada does not have a corporate income tax and thus would not tax the share of profits that are earned in Nevada. And I always get these confused. I think throwback is numerator, throwout is denominator? Throwout's denominator. So depending on which rule you use, it's excluding that income and from either the numerator or the denominator, and then being able to tax in West Virginia. And put more succinctly, West Virginia is taxing income earned outside of West Virginia but not taxed by another state. And it's alone with New Jersey on that. And then Ferdinand will go and answer any questions you have on that later today. But, I mean, this just further exemplifies why I had a bit of an exception to the statement that West Virginia has pretty good taxes. I think West Virginia used to have awful taxes. I mean, it was almost a wall around the state. And if site selectors or if people like Ferdinand from Cost or other people in the business community were asked, what do you think of West Virginia's tax system? It's like, you don't want a piece of that because, you know, they've got this franchise tax and they've got this and they've got that, and it's a mess. You no longer have that wall. Now it's more of well, they're kind of high on this, they're kind of with everybody else on this, be careful about this. But at the same time, it's not anything glowingly positive. There's no great strengths, at least as far as the tax system goes. Now, you have many great strengths in terms of natural resources, in terms of coal, which is a strength and a weakness, of course. And the weather, at least today, is gorgeous, and you know, you can go on and on and on. But in that basket of things that sells West Virginia, is it enough to draw people here? And you know, that's the big question.